Today we're going to go over a Forex charts strategy with regard to support resistance. A lot of people have a misunderstanding about support resistance, thinking that the market needs to go right to the previous high, the previous low, the pivot level, the Fibonacci level, whatever support resistance level you're looking for in your Forex charts. And that is absolutely 100% not true. Support resistance levels are not lines. We see them as lines on our charts, but they're actually zones. Now, that makes it a little more tricky to establish exactly where those value areas are, so we need to have an objective strategy for doing that. That's what I'm going to share with you today. So, right now we're going to look at just very simple previous highs and lows. So here we have a previous high, and then here we're coming up to another high. Now, a lot of people would say that this high did not provide resistance for this high over here because it made a lower high. And that technically is true, that it made a lower high if you're just simply looking at the highs themselves. We have a high here and a lower high here. However, that is not really the most accurate way to look at it. And the reason is this. In my trading approach, I talk a lot about market logic. And by the way, I've noticed a lot of other people stealing that term from me lately, which I'll take as a compliment. But all my trading is based on market logic, which essentially is founded on the principle that markets are huge auction places. That's what they really are in real life. And so if we want to have a strategy that's going to work and continue to work in the future, it needs to be based on the logic of masses and masses of people and how they operate in an auction place. And so one of those principles when it comes to support resistance is that the markets are a bit messy. They're not completely accurate. In other words, what I'm talking about here, let's look at this again. So we made a high here, and that's great, and a little bit lower high here. To expect the market to go back up here, and let's actually draw a horizontal line. Let's make this really pinpoint precise. There we go. So if we mark it right at the high, a lot of people would expect the market to come back up and reach that high, the highest high that was previously made, as resistance. The problem with that is markets are not that neat and tidy. And again, to translate that into market logic terms, human beings, as they behave en masse, remember this is the euro-US dollar. So we're talking about the Forex market. First of all, there's no central exchange. Number two, you've got people all over the globe trading this thing. So you've got masses, hundreds, thousands, millions of people all trading this. And so to expect that the market's going to be perfectly accurate at coming up and touching this high and then going down, well, sometimes that happens, but that's the exception to the rule. So we have to allow for that messiness of human behavior. As it comes up to that high, people get a little afraid, a little scared, or maybe they'll get overly aggressive. We have to account for both of those because that's how human beings operate, is they operate in emotional ways. Fear and greed being the primary two emotions in the markets. So instead of using the highs, what I like to do is use the candlestick real bodies. So I'd bring it down to there. And this is one approach. There's another technique, and I'll show that in a future video. But if we use this, then what we're saying is these wicks here on the candle, or these shadows on the candles, are areas where the market did not find real value. And it rejected these values, to use market profile terms, and that this is really where the significant resistance was, where the real bodies are. So that's where we need to start looking at resistance. And since the market does come up and hits the line that we would draw off of the real bodies, therefore we would say, yes, this high did provide resistance for this high. And that is a very good way of doing it. Now, let me show you another way. Another way would be to look in this area and connect as many of the bars in this area or in this zone as possible. So we could go back to this, connect that bar, and then 1, 2, 3, 4, 5 bars. And then you'll see that it brings it down even lower, and it connects with 3 bars instead of just the 1. Again, this is just a very logical approach to say that this zone or this area within here is where the market found a lot of resistance to go up any further. And instead of looking for the extremes, look for where the majority of the voting was. You can look at it that way. The majority of the voting was as far as people starting to feel that this is getting overbought. And connecting the most bars together there and using that as your line for your resistance. So bottom line, remember, support resistance levels are not really lines, but they're zones. And so if you use either one of these strategies, either by drawing it off of the real bodies or connecting the most bars within that area or within that zone, then that's one way of assuring that you're looking at zones instead of just lines. And therefore, you are accommodating the, not just idea, not just the principle, but the fact that markets are a bit messy, they're not completely accurate, and when masses of people are trading, they're going to get a little scared, get out a little earlier than the recent high, or maybe get out a little bit later. And on the next video, we'll look at what happens when you make technically a higher high, but it's really holding resistance and is not really to be considered a higher high. So we'll look for that in the next video. So if you like this video, please click the like button below and leave a comment telling me what you'd like me to cover in future videos and what you liked about this one. Also, I'm giving away one of my favorite trade strategies called the rubber band trade. And this is a great trade. I personally still take it every time it sets up. It's got a really high win-loss ratio, and it's very simple. You can learn it in about 20 or 25 minutes. So you're going to get that video explaining the trade strategy absolutely free by clicking on the image in the top left corner, or if you're on a mobile device, click the little eye with a circle around it in the top right corner of this video. And once you do that, I'll personally email the video to you.